Now that we have our income statement built, the next thing to determine is how we're going to pay for all these estimated costs. Here are some common ways to fund a business. This is not a complete list, but some of the more common methods. There's bootstrapping, meaning it's owner-funded. There's loans and equity investments, either from angel investors or venture capitalists or VCs. Then there are other ways to fund a business, like through crowdfunding or competition-based, meaning you can participate in pitch or business plan competitions. There are grants. There's rental assistance. An example of this would be Kimco Keys. There's Economic Development Council initiatives like San Diego North or World Trade Center Metro Connect. These are government-funded programs to help revitalize a community or bring businesses back, because businesses typically bring back jobs and helps the local economy. And then there are entrepreneurship-based programs like 1 Million Cups. And last but not least, there are special incubators or accelerator programs, especially done through universities, or sometimes big law firms will also sponsor these. Bootstrapping is financing a startup without the financial assistance of others. The term bootstrapping started in the 19th century and refers to pulling yourself up by your own bootstraps. It implies to make something out of nothing with hard work and grit. According to Fundera by NerdWallet, about 77% of small businesses rely on personal savings for their initial funds. A third of all small businesses start with less than $5,000. The average small business requires about $10,000 of startup capital. So it's entirely possible to initially fund a startup without any outside assistance. What do we mean when we say personal sources? They include savings or investments like stocks, 401ks, IRAs, home equity loans, personal credit card, and gifts. Debt is loans. With loans, you get to keep control of your business. Once the loan is paid back, the business or whatever collateralized the loan is yours. Collateralized means there is an asset guaranteeing the loan. For example, most car loans are collateralized with the car. So if you default on your car loan, the bank repossesses the car. And the last advantage of debt are the potential tax savings associated with deducting loan interest. However, loans have to be paid back with monthly payments. Interest rates can vary and can be quite high, and sometimes the loans require balloon payments, which are large payments towards the end of the loan. The two most popular forms of debt financing are traditional business loans and loans from friends and family. A brief word of caution on taking loans from friends and family. Make sure you have this set up as a business deal. Do not be relying on the generosity of family members. Know that by loaning you the money, they are taking on risk. And they have opportunity costs because that money cannot be invested elsewhere, earning interest or dividends or appreciation, as in the case of stocks. So you have to compensate them for that risk and for that loss of interest or dividend potential from not investing their money elsewhere. Also realize that they are expecting to get paid back with interest. So when you're setting up these loans, make sure you are compensating your family and friends for giving you the money and believing in you. And you make sure that they understand the risks involved. Quite often I've seen family and friends loans go south and destroy families and friendships. So make sure if you are using this method of financing, you have everything set up legally and you all understand the risks associated with doing this method of financing. Traditional business loans are usually done with outsiders, like a bank or the Small Business Association, SBA loans. So let's start by looking at the basics for the equity decision. Selling equity means someone believes in your business concept and is willing to take a chance on your success. You receive assets, usually in the form of cash, in exchange for ownership in your business, and it does not require you to make payments in the near term or maybe ever. You need to be willing to open your financial records and share proprietary information with potential investors, and most likely you'll need to talk to many investors before finding the right fit. Pandora, the music streaming company, talked to over 300 potential investors before they found the right ones. As you can see, it takes a lot of work to secure an investment. The bottom line is that you must give up some control over your business in exchange for funding. Equity has unlimited potential for fundraising, whereas debt is limited to the borrowing power or creditworthiness of the owner. How much an investor is willing to invest depends on the growth potential and profit potential of the business. It's more of a gamble for the investor, and they share in the risk of business loss. And there is flexibility as to the amount of timing of dividend distributions, meaning if the business is short on cash, it doesn't have to pay a dividend, whereas with a loan, it still must make the payments in accordance with the terms of the loan. But with equity, the owner loses control over the business. If the owner relinquishes more than 50% of the ownership, they no longer have a controlling interest, and the owner must share the profits with the other investors according to their ownership percentages. Lastly, experienced investors have tougher terms, and a lot of small business owners don't understand what they're giving up in exchange for capital. Why would an entrepreneur choose angels or VC over debt? Well, they just might prefer equity. They don't want to make payments, or they have a high debt ratio already. They want or need VC involvement. Many times VCs help run the business. They want to protect their investment and be part of the management team. Other times the entrepreneur wants a partner with startup experience, especially if it's in the industry. Entrepreneurs also gain access to the angels and VCs professional network. So there are other resource angels or VCs bring to the table besides cash. If you recall from my income statement, startup costs were significant at $176,052. I'm rounding up to $180,000 needed to start my coffee house. I've decided that I'm going to bootstrap my business, meaning I'm going to take money out of my savings to fund my business. Another part of my bootstrapping is not taking a salary for the first 12 months. Between the $180,000 I'm putting into the business and my salary deferment, that is my skin in the game.